After Friday's price action and Wednesdays and Thursdays, it's hard to imagine that we were actually green for the week. We were green by about 50 handles. But is the Friday sell-off going to turn into a Monday rout? Well, we're off the lows of the session, but we haven't gone green yet. I would take a tick gain. Settle above 53 and a quarter, 53 and a half. Can we get to Thursday or Friday without another earnings warning? I mean, just keep things quiet, at least till we get the CPI on Thursday. We got a big week, folks. We got to hold those lows from last week. Mitch, get us started with pre-market prep.
Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I'd buy that stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. I'm serious. I'm not serious. I'm in a great mood here on this Monday morning. S&P futures down 6 and a quarter at 36.47. Got to get green. First things first. 53 and a quarter was the close. The buck doesn't want to stop here. Didn't even blink at that 50% retracement of the recent break, up 27 cents at 112.95. TLT, I mean, we know where that's hanging out near the low of the move, down 48 cents at 100.51. Crude still hanging on to those OPEC plus gains, but we got a little bit of a red candle, down 52 cents at 92.12. Gold going opposite way of the buck, down 25 bucks, 1684.30. Bitcoin, that's in the red too, by what, 400 bucks, 19,855. Bitcoin, or excuse me, that was silver. That was wrong. Silver's in the red by 40 cents, 1985. Bitcoin's just down $115, 1829. And then Ethereum, that's down $15 at 1309.50. We're going to bring in Triple D and Mitch here, and we have a very important question for Dennis. Dennis, are you ready for this question?
What's up?
So it's the Canadian Thanksgiving.
Yes.
So for the Canadian Thanksgiving, do you eat turkey or Canadian geese?
All of the above.
Really?
Not polar bear?
No polar bear. Actually, no. I've never ate Canadian geese either, but it's probably. I think you can eat it. I don't know.
What about black bear?
You can eat goose. I don't know if that's Canada goose. Yeah. No black
How's
bear.
that stock doing?
Some people do. Some people eat black bear.
Have you ever had some bear?
I'm pretty. The problem with me when you ask me stuff is I'm such an Americanized Canadian. So, and the reason for that is I was born in Windsor, which is literally a suburb of Detroit. We cheer for all the Detroit teams. I mean, that's why everybody calls Windsor. They kind of don't even really consider it part of Canada sometimes. The auto city, we supply all our parts. 7,000-8,000 people work in the States. So, and then our television growing up, because we didn't have streaming and all this, we're watching the antenna. So we're literally watching Detroit television. So I grew up watching Detroit television. When I come up and I've moved up to Georgian Bay, they say, "You sound American." That's what they say to me. They say I have an American accent. I was like, I don't think I have an American accent. I think I have a Canadian accent. But watching TV all those years, maybe we do. Windsor's a little bit different. So we do consider ourselves a little bit American. So I'm probably not the person to ask about all these hunting questions. Not a big hunter.
Okay.
Kind of a little bit more Americanized than your traditional Canadian. Although I love hockey and I try to like the Lions. But I wore the hat just today, Joel, just because I didn't have it on. But bad teams find a way to lose. We can score 45 points and lose. And then we can score 0 points the next week. So it's impressive, So I thought I'd just wear the hat just for those reasons.
Give us something.
And the hats and the hair is really, really bad.
Yeah,
today,
really.
So
I know. I wasn't sure.
You laughed at my hair this morning. I was like, I'm really putting the Lions hat on.
I don't know if that's going to save you much, but definitely it looks like let's get into the market talk.
Sure.
We got the dollar bouncing off. Will the dollar kind of get towards some new highs? That's what I'm keeping a close eye on right now. Looks like we got that bounce in the week last week. I've been looking at the DXY, looking to see if it gets over 114.10. That was last week's high, and we did bounce off around the 110 right now. And DXY, we're at about 113.12.
It's a
I mean, the
trend.
dollar, we can
Yeah.
keep looking at the dollar all we want. The dollar is simply inverted to the equity markets. It's been that way for 10 years. It's been that way for 10 years. You know, weaker dollar, strong equity markets. You know, it's not a coincidence. And you can say, oh, is it the chicken or the egg? Is the dollar driving the equity markets? It probably flips back and forth to a certain extent, just like the futures traders, S&P futures traders say, we absolutely drive the equity markets. With equity markets, the traders will say, well, no, the futures. And it's a little bit of both. There's give and take. But whenever you see U.S. equity markets in, you know, the gutter, which is what they are right now in a vicious bear market, the U.S. dollar is strong. And the reason for that is safety. They're looking, you know, when you're money manager, you're moving over to U.S. dollars. So you're going to see the U.S. dollar. That's the area where the whole world really considers it still the safety trade. So it's not surprising. So the U.S. dollar will remain strong as long as equity markets remain weak. So the inverse correlation is there. Chicken or the egg, I don't know which comes first, but that's what you need to know.
Well, what changed last week? Well, we could definitely take a look at the trend in oil, right? That's definitely has been a change in trend, starting to push. I was looking at WTI. It's at 92, looking to see if it can hold the pullbacks to 90. And of course, it looks like we're getting a little bit of a pullback day today. But what do you see, Joel?
When do they, I mean, OPEC Plus says they're doing this, but when like do we get the actual numbers, like what they're doing or what they say they're doing? Is that like, will that be reflected and like it comes out on Tuesday and Wednesday, right?
Yeah,
The inventory numbers. I mean, I think, you know, they did it. They got their desired move, right? If you were fading that move, you got absolutely run over. They're pumping. I mean, I still think they're pumping at the highest levels that they can with crude at this price. So, you know, you can't stand in front of a moving train. I'll try, but you got a pair of highs here, right? We've taken out Friday's high just by a little bit, 93.31, 93.55. We're in the 92, lower 92 handle. So I'll make 93.5 a 3-star. And if it blows through there, then it's going to 95. So right now you have two highs in the same area. You're lower on the day. First red candle in a long time. So that's my technical take.
That we talked about that inverse relationship that existed for a bit, and then it obviously everything started moving together as the VIX was starting to get higher here. You've got an inverse relationship, and it was a couple people in the chat pointing it out on Friday. It's back. Oil rallying up, and the equity markets are like, uh-oh, that's inflationary. So, I mean, it's not helping the cause. You know, we know oil has been helping the last couple of CPI reports, and it still might help this next one because the data lags so badly that you'll be looking at depressed oil prices probably in the next CPI report. But now you look beyond and you're like, okay, well, this move is going to show up somewhere else again. So it's so tough to just come in here. I just, again, you know, it brings us right back to, you know, and Mitch, I got to give you some props again. You know, you were dead right on Friday. I was wishy-washy. I'm like, I'm going market neutral because I don't know what this number is going to be like. They didn't like the number. And then you had nuclear war talk, and that didn't help the markets either. You know, we don't even want to get into that, but it did not help the markets. You know, the Biden comments about nuclear Armageddon, none of that helped the markets. You know, and you could clearly see the war trade starting to go back on Lockheed Martin, starting to catch a little bit of a bid. And then obviously oil prices as well. But, you know, that's a whole nother thing to worry about. And we've said on the show before, there's no sense worrying about nuclear war to a certain extent, because if we go into a nuclear war, we don't even have to worry about stocks. So we'll have a lot bigger concerns. So let's assume no nuclear war. And let's, you know, just look here. Still, the path obviously is not a good path here. You know, you look at earnings season coming. We get an earnings warning from AMD. It looks like it's going to be maybe okay. It's down $2. Well, they're kind of taking stride. They just punished it all day. That is not the reaction. As a bull, or even as a bear, as a bull, you do not want to see that reaction. You want to see, we talked about the silver lining market. There's going to be a lot of bad earnings warnings coming this earnings season. It's not going to be a good earnings season. I'm fairly confident of that. The market needs to start finding the silver lining, or otherwise these indices are going to be much lower after this earnings season.
Yeah, market factors didn't help it. I mean, at all. It just we talked about it was hovering at the 64. We were looking at that before the number came out, and it still managed to like hang in there. But man, that pivot area, I mean, 64. I think it opened right near that area. I mean, you just got to go to the monthlies now if you're AMD and maybe sit back and wait for the lower 50 handle. 5160 was your low in July of 2020. Wow, getting to 2020 levels.
I mean, and Nvidia too, and what I want to say as well, with these P's, when you're looking, oh well, Nvidia is cheap relative to itself. I mean, is it really? And Mohamed El-Erian, I love Mohamed. There's a lot of people come on CNBC and they don't know what they're talking about. Mohamed El-Erian is not one of those people. We've had Mohamed El-Erian on the show before. Just interesting, and I only caught a little piece of it this morning because I was busy trading. But just this one quote, I just wanted to repeat it. He's asking Joe Kernan, and Mohammed's been bearish for quite a while here, and correctly bearish. But he says that we're on a bumpy road to a new destination. And then he started talking about different valuations, not having easy money. And I mean, that is just the perfect analogy of what is happening here. I mean, we are revaluing stocks for new rates. That is really what is happening. We're revaluing stocks in a world where it's not free money. We're revaluing stocks in a world for 5% interest rates. That is a huge, huge difference. You revalue. I mean, interest rates drive the bus in the long run on everything. And you go from a risk-free rate of 0.5% up to 4%, and destination right now looking above 5, stock market just gets killed. So it's just followed that path perfectly. I mean, the only way really to get back up to these 25 times, 27 times S&P multiples, which were absurd to begin with, is that rates actually come back down. And they might, because I think we're going to throw the economy into an ugly, ugly recession here because these rates are higher. But it's going to show up. The bumpy road to a new destination is a new destination of new multiples. So when you're looking and saying, hey, Nvidia is cheap at 28 times because it was trading 45 times, is it? Is it cheap? Ask yourself those questions. In a risk-free environment of 4% or even potentially 5% if we go another point and a half, these stock prices still don't look cheap.
Dennis, you're talking about their monetary policy, and there's always two areas that we need to pay attention to, right? The monetary policy and the fiscal policy. Well, we got kind of a fiscal policy update here coming from the government about China tech down right now on export controls getting tougher as sweeping new U.S. regulations mean that companies must apply for a license if they want to sell certain advanced computing, semiconductor, or related manufacturing equipment to China. The U.S. announced on Friday the changes also mean that foreign companies will need a license if they use American tools to produce specific high-end chips for sale in China. This is one of those red flags that I've been waving for a while now that I feel like no one's truly paying attention to this. This in the long run, I think, is going to be a huge detrimental to the revenues of the semiconductor companies.
Mitch, this is another. There's just such a plethora of things going wrong to be an equity, like to be all in equities here. And China is a big concern here as well. And we've talked about, the China concerns. And I mean, you can talk deglobalization, you can talk all that stuff, but bottom line here is there's supply chain issues, there's issues. They still have that stupid zero COVID policy there, which is impossible and full of lies. So, I mean, you look at this China FXI and you think, we're $50 in April of 2021. Here we are a year and a half later, it's 25. We got cut in half. More. You got to go back further on the chart because it's 52 or 53. And then you look farther and you look, well, in 2016, let's go back 7 years ago. Let's go back 6.5 years ago. We were $28 at the low. Here we are 6.5 years later, and we're 25. I mean, China really didn't participate greatly in the previous 7-year bull run. and now it's making new lows. Do you think it's bad in the U.S.? It's a lot worse in overseas equity markets. I'll tell you that much. I'll tell you, investing overseas has been a punishment for basically a decade because of the underperformance. And now these countries are leading the performance on the downside. So there isn't a catch-up trade here. It's us trying to catch up to them to a certain extent because they keep leading the charge down. Europe's a mess. China's a mess. U.S. feels like a mess, but it isn't even that messy yet. Tough markets.
Look at that. I'm looking at the high in June of 2007, or excuse me, October of 2007. It hit 72.26. So you look at things on a relative basis. See, and then there's another thing here. If I don't want to spend the whole day on oil and stuff, but where if China's not doing much, if the economy's shutting down, I mean, where don't they use a little bit of oil? Is that gonna have more supply on there? So I don't know. It's
and that's why I've argued, and I've been incorrect on oil for a long time, but I've argued if we go into this global recession here, which we are, I think there's less demand for oil. But you throw war into the equation, that changes things too. So that's definitely something to consider. So, we got the Ukraine war. We don't know what China's thinking on Taiwan. Well, we know what they're thinking. We don't know what they're going to do. So, I mean, war is a completely different animal here. Oil prices will definitely go up if war continues or if war escalates. So war appears to be not going away in Ukraine and Russia anytime soon. Seems to be getting worse, with what, the discussions are. But oil prices go up in a war. So that's one positive catalyst. But still, I'm not chasing oil here. I sold my Oxy. It's one that I bought on the dip, which I bought a little bit too high, and then it's just had, a move almost back up to the highs here. So I just am still on the bandwagon of long term. I think we're going lower here. So I'm using RIPs to raise cash.
Didn't Elon come up with something to solve the Taiwan situation too over the weekend? Did I see that headline? I guess I'm the only one that saw that headline.
I don't know. Elon tries to solve all the world's problems here.
Yeah, he answers to everything. He answered back to Kathy this weekend. He answered back to just about everything. But let's get into another headline here. Let's go to the pair of downgrades coming in the autos from UBS. First one we'll talk about is Ford Motors, as UBS downgrades Ford Motors to sell and lowers price target to $10. Ford ranks behind GM in terms of North American EBIT margins, and in light of likely recessions, has the highest risk of testing break-even points in our views. And the downgrade stated in the note, the European business could become loss-making against a difficult macro backdrop, a potential setback to restructuring achievements made.
Who upgraded this last week? Wasn't it upgraded?
Let me just
I feel like we talked about it on the show. So I said I would fade it.
I can look right quick.
I think you're right.
I remember saying I would fade this because I don't think they're reading, and I talked about going into the auto lot and seeing pretty much a ghost town.
You got Morgan Stanley, I think, that came out on the 5th. And so I'll give you it right now.
That was the move up.
Upgrade. Yeah, it's an upgrade. They did from equal weight to overweight.
Yeah. No, that was a bad call. It's 3 days later. It's 3 days later, and we could already see it as a bad call. They came in selling that. These autos are going to be a mess. Sorry, D-Town. Sorry, Windsor. I just see that bumpy path revaluation is going to really affect automotive purchases. I just don't think people are paying those amounts for these cars. I think the rich are still going to buy them. There was obviously, supply chain issues. So, it looked like, we're still selling trucks like crazy. We're still selling cars like crazy, but that demand destruction is going to start to happen here, I believe. I think, the market has priced a lot of that in. It's why I sold my GM and Ford a long time ago. I think Ford is eventually a single-digit stock.
If you're waiting here, if you're so inclined to play a gap fill here, you had a really nice move that was probably off the upgrade. And you're filling the gap here at the 1159 area. So you're coming right back down here. The low of the move is just above 11. There's a pair of lows, 1113, 1119. So That's what you're looking at. It was stubborn last week. I was wondering if this was gonna, fill that had that little gap from when they gave the earnings warnings, but now we know why it wasn't filled. So recent low of the move, actual tick was 11.13.
And of course, there was comments over the weekend from Kathy Woods talking about how gas-powered autos are likely to plummet because of everyone shifting to electric vehicles. Elon tried to agree with that, but let's keep going with the UBS downgrade of GM from buy to neutral and lowering its price target from 56 to 38. While we continue to like GM's EV momentum in 2023 with a strong IRA compliant launch pipeline, the overall sector outlook for 2023 is deteriorating so fast that demand destruction seems inevitable at a time when supply is improving.
There you go.
And then
That's
they
exactly
also
what I just
stated
said.
that they expect EPS to more than half for next year.
I think so. I'm right there. UBS, right. Morgan Stanley, wrong. That's my opinion. Kathy will be right here. Kathy will absolutely be right with those comments. She is so early. She is so early and trading, and buying these things at just such ridiculous valuations. She is so early. The global recession is just going to punish her. I tried to buy RKK for a day. I got up like 5% a day. I was like, oh, this is good. And then you stop. So this is how these swing longs work. You try to go and
that Tesla buy. That Tesla buy was not a good time.
Hey. I mean, she's got her beliefs, and maybe in the long run, and obviously she has the long run, she's going to be right. But maybe ARKK is like $10 at that point in time, and then it goes from 10 to 40, and you're like, oh, she was right, but she's just too early, man. She's very right with the call. We will all switch to EVs. I think 10 years from now, we're all driving EVs. So I do, and that's why the long term, for oil is not good. The long term prospects here, but it's 10 years from now.
Dennis, let's just be real. My car right now will probably still be driving in 10 years. I'm not going to just stop driving it because someone wants to drive an EV. Gas powered cars are here to stay at least until they get taxed so hard that you can't have them. I think it's
10 years out. People who think it's a year out, and there's definitely more EVs on the road. You can slowly see this happening, but it's not going to just be boom, boom. And throw a global recession in the middle of it. Nobody's paying this for cars. These EVs are bloody expensive. This is not the time to be bullish EV. The story was cool a year and a half ago. We were in better times, free money. No free money. I'm going to drive my cars too for a lot longer here, Mitch. I don't want to go pay right now. What's the Lightning? How much is that bloody Lightning? I'd love to have it.
65,000. It's okay, Dennis. No
How
worries.
much? 65 US.
Yeah,
that's like a 90 Canadian, 95. That's a base.
It's all
then
good,
you want to
Dennis.
put a few toys on that. You're over 100 grand Canadian. You're way over 70 US, 75 US. Who's buying that in a recession? The rich people, but they're not everybody's rich.
Yeah, I'm not driving an EV for a very long time. I don't even think they're fun to drive. And I barely drive, so I'm going to use something that I think is fun to drive.
They're kind of fun. They're kind of fun to drive.
What? Those plastic pedals that you just hit and you don't hear anything?
The Tesla's fun to drive. I've driven the Tesla. It's fun to drive. So it is kind of fun.
I drove the top too. Tesla, the Yes. Still nothing.
I can absolutely guarantee that I will be driving a lower priced EV in a lot sooner than 10 years, maybe 5 years.
Oh, I think so, Joel. I think
what kind?
What?
A golf cart.
Yeah, you're gonna a man-powered bike.
No, a golf cart, man. When
the
old people, where they live in these places.
Joel,
and
you go to Florida. It's not the old people; it's everybody. They just drive around the beach.
I have a really
sweet
golf cart. No, man. Mine will have I will have. You know what? I'll make it. I'll like the Michigan football helmet. I'll get it painted like the front of the Michigan football helmet. That's my.
I'll tell you what. Just make sure that it's not a Rivian. It seems like because it looks like Rivian is doing a little recall here. Rivian announced voluntary recalls of its EV. It delivered its customers as they identified issues with a fastener, according to a letter sent by CEO. In rare occurrences, the nut could loosen fully, he added. While we've only seen 7 reports potentially related to this issue across our fleet to data. Even one is too many. Remember, earlier in the week, last week, the company had affirmed its full year production guidance of 25,000 units. I wonder if this is still in line.
I love this news drop on Friday night. This hit too. And then it was like, we're recalling, I don't know if it's a small number, but it was like a number, we're recalling, it implied that it wasn't that many vehicles. And then you add it up, it's like, well, that's pretty much all your vehicles that you
Well, they don't make that many vehicles.
I mean, oh, yeah, exactly. So yeah, small number because you sell a small number. So you basically put out all these cars, which, you're not putting out very many cars. Now you just recall them all. I'm like, holy mackerel, what a blank show there. So anyways, whatever. It's down 7%. Deserved. Valuation is still stupid in the stock. It's obviously doesn't make any money. So you can have at it. That's what Dan Nathan says. Have at it if you want it. Not for me.
It had that pop last week, and there really wasn't a good area to sell into it. And as far as the daily goes, but it took out that low from Thursday and Friday. You're in the 31.5 handle. I mean, if you want to, I don't know if you want to try and bring in a short. I don't know if I'd initiate a long in this thing, but you do have multiple lows. 30.85 to 31 area. That'd be getting it down a lot today. If you're looking for resistance, yeah, you might fill the gap there. A little bit of rally up to 33.01. That was yesterday's low. But as we speak today, there's multiple lows under $31 in our IVN.
Okay, so it was the Rivian is recalling 13,000 vehicles after a very small number were found to have a structural issue. So maybe I confused it, saying they were recalling a small number of no, so it was a small number that had a structural issue. So they're basically calling all the vehicles. So yeah, not good news.
They said it's at least a quick fix, that it only take like 30 minutes, but still, this is not what you want to be hearing, right?
I heard an interesting
burning more cash.
I heard an interesting thing. I think it was headed to the pool on Saturday. That GM is just going out on this massive hunt and recruiting for mechanics, because they're saying that once we switch, I don't know if this is a good sign or not. They got to retrain the mechanics.
Exactly, the retraining.
And that there is a massive shortage for mechanics.
They need to become more electricians than they are mechanics anymore once it goes to EVs, because they need to be so aware of what goes on in batteries that you're going to need some retraining there. And I mean, at least this opens up some more jobs. Those schools, those tech schools will get a little uplift. Let's keep going. Let's get to the
PayPal news. They're all talking PayPal.
Yeah, let's go PayPal right now. I got you. That's next up here. So PayPal is pulling back on a policy that would have fined users $2,500 for spreading misinformation, claiming that the update had gone out in error. Former PayPal president David Marcus even blasted the company over the implication that it could seize customers' money for finding their views objectionable. They pulled this back real quick. Let's just put it this way, guys.
It went from growth stock to value stock to, I don't know if anybody wants a stock, but it's hard to find its way. Had a nice run July from 70 to 100. Everybody's like, oh, here's the comeback trail. They just don't come back. So, I mean, it absolutely needs to hold the 84.13. That's the low of the move. You do not want to see that taken out, because if it takes up the 84.13, you start thinking about this thing back at $70. Could it go there? It could. I mean, global recession, not good for buying stuff online either. So valuation has gotten reasonable, but in global recession, that E starts to come down, that PE starts to go up because of that. So I'm just holding off on PayPal. I don't think the story is anywhere from, I think the story is ice cold.
Don't know about the 70 level that Dennis is talking about. It's getting hit quite a bit, down 345. I would just look at it from a shorter term perspective. Maybe today, someone had been at 85 going all the way back to August. They nibbled a little bit in September. Haven't been down there in October. So if you had some puts or looking to perhaps start along, then hey, we just popped here. Not much, but 8:30.
Yeah,
no number.
Yeah,
number?
we're trying to go green, man. I think we're trying to go green. That is That's all I want.
That's
I
good
want
news.
a settled. Did we get something? Did Tudor
No,
Jones say something positive?
at least there's
No.
nothing on my end here.
Here's the
Okay.
problem: is you had such an ugly tape on Friday. If we get any type of rally here, just going to be met with so many new sellers, including myself. So I mean, I look up there, you get near 366, 367 SPY, sell more stocks, get back up to like 55% cash, where I was at the peak, because I think we're going lower. So I think Mitch was right. I think I was wishy-washy on that number. Obviously, I said I was going market neutral. Wish I would have just been on Mitch's full-on bear train there. I wanted to be bearish, but I just wasn't being allowed because I liked the tape. I liked the price action before that. Price action on Friday changed everything. So now you got a whole bunch of bulls that were thinking, maybe the blow is in. They literally, like Mitch, for 3 days in there, 4th, 5th, and 6th, people are like, yeah, the lows may be in here. But man, bring on CNBC. Boom.
Oh, man.
One day, boom. Like CVS. Like, do you want to invest in stocks when you see crap like CVS?
Yeah.
And I mean, it's here's a stock that's got a low beta, moves around, you're sitting there, you're kind of in it for the dividend a little bit, 2%. It's safety trade, right? I'm kind of safe. Where's CVS going to go? Market gets really ugly, it goes down a little bit, but I'm pretty safe in there. Now, boom, pull the rug out from under this thing. Let's just knock a year and a half of gains off this thing in one day.
Yeah.
This is just this investing in a nutshell. People who have these safety trades are getting beat up now too, and they're like, I just have a bad taste for stocks. I mean, XLU straight down for a month here now, deserved, because everybody's crowded into this and we're not considering that, hey, maybe higher rates aren't good for utilities, but whatever, people were ignoring it. They're not ignoring it now. So the safety trade is coming off here now too. Maybe that's, meaning we're getting close to a bottom, but again, I see stuff like CVS. I think you just turned a lot of investors off.
There was also an upgrade for Toast. If you guys don't know Toast, that's TOST. Mizuno upgrading Toast to buy and raising price target to 24. This is kind of a payment. So they just see their margins decent here. I mean, at least the chart doesn't look too bad, hanging on compared to
great either.
Other software stocks. I mean, at least going sideways for the year. I mean, think about where it was at the beginning of 2022. It was only at 2053. So, I mean, technically didn't get destroyed like the other software throughout the year.
It's got to get above 18 till it starts to even get interesting. And even if it sticks its nose above there, like Joel would say, let's get some closes, let's get some support, let's get something going above 18.
Toast?
Otherwise, you're toast. Yeah. This valuation, I'm assuming, I don't know anything about, like, I know this company, what it does, but I don't know anything really about valuation or anything. I'm assuming it doesn't make money. I don't know. This is just not the stock to own going into a global recession.
Yeah, getting a nice pop, 24,000 shares. Just we're not even in the 17 handle yet, but Thursday's high, which was also the high for the week, was 1852. What was that close on Thursday? 1794. So you're not even at the high close for the week, and that was a double close. 1787 Wednesday's close, 1794 Thursday's close.
And of course, this week we're going to have a lot of numbers hit the tape, right? There's a lot to keep on watch. We got Wednesday PPI will be coming through. We got on Thursday CPI, and then Friday retail sales. So a lot coming through. Of course, consumer price index for September is expected to show a significant moderation on the year over year. It's supposed to come down to 8.1 from 8.3.
When's the CPI?
That's Thursday. And so
this is big week. And then you get an earnings season on Friday, and you're going to get into the banks. And we probably should preview the banks. People were asking in the chat, what do you think about the bank earnings? One thing I'm going to say I'm fairly confident in is that investment banking earnings are going to be just slammed.
Horrible.
So you got to pick it up somewhere else. But the investment banks, the traditional ones, obviously, are going to get hit harder. I think the numbers are going to be absolutely terrible for investment banking. Think about, the IPO market. Think about just, the capital markets altogether. I mean, I mean, there's not a lot of quarters that Goldman Sachs, ever misses. I just don't know going into here. Is there a possibility that one of the big guns, one of the big investment banks could miss here? Possible. If they can pull off rabbit out of the hat here and have good, numbers, I'd be impressed.
Yeah, you mentioned the IPO when we had Eric on. I mean, there's just absolutely nothing going on in the IPO market.
Nothing.
And then these big houses that are, managing the funds based on the percentage of assets. Well, the percentage of assets is
Going down.
going down. So it's still the same percentage, but the assets are going down. Well, the first one is JP Morgan. And the thing to kind of tell on this, I mean, it's participated in some of the rallies, but where the S&P and a lot of other stocks took back half of that move. I mean, from the even from the September high, this didn't even it didn't even sniff it. I mean, just lower high after lower high. Bank America just hanging out just above. We got some optimism going on, folks. I don't know why.
Joel.
We got a rally. This ain't no rally. And you know what? There's nothing in there. Because if you tried to buy this market on Friday going down through this area, there was nothing in there. There's nothing in here going up. And it seems like they kind of do it. They kind of, they tease you. They let it get up into the open. And then kapow when the liquidity comes in. But do we have Mr. Quast yet?
Not yet. He's not in here just yet. He should be here soon. But one of the things that I think is interesting is the estimates, right? If we're only expecting CPI to come down from 8.3 to 8.1, is it really coming down fast enough to even think about it being in like that it matters here? A little part of me showing that just shows me that inflation's not coming down fast enough. Even the expectations aren't for it to come down.
It's not coming down for sure. It's not coming down fast. We can't get out of the 8s.
Yeah. I mean, this is gonna be a while, man. I mean, I was expecting by September to see 7s, but we're still talking about 8s.
It takes time for the Fed's plan to work here, and the plan will eventually work, but just takes so much time, and the consumer is bloody resilient. So eventually they will break the consumer. They're creating, again, if you're buying stocks, you're fighting the Fed because as the consumer continues to spend, as you get decent jobs numbers, as you get the Fed's like, we got to tighten harder. I mean, this is such a weird recession that, Fed-induced recession. And you can blame the Fed for it, but they still don't have a choice. They got to get inflation in check. I don't know. This is just such a weird recipe here. And you can go back and look at stats, say average bear market's 9 months and, and all this. We're just in such a different environment. And I know what we say, everybody always says it's different this time. But the big difference here is that all these other rallies are built on free money. This is like the driver of it all. It was QE. Joel, when we were coming out of the financial crisis, what brought us out of the financial crisis? QE.
Money. Well, there might be one that brings us back into it called the quantitative tightening, right? I mean,
again, that might be it. So if the Fed staying on the gas, stocks still get kicked in the ass. There's a saying for you.
All right, let's get out of the earnings for this week. Let's go to our guest today, of course. Guess what, guys? Hit the thumbs up. It's back. Market Structure Monday. All right, we got Tim Quast back in the hot chair. And of course, everyone's been asking me, where's Tim? Where's Tim? We need Market Structure Edge.
I've been eating pasta, as you can tell.
Oh, man, share the love. Share the love. Nothing wrong with some good pasta.
This is what eating cacio e pepe and amatriciano and this is what will happen to you if you do that. So I had to get back to Colorado before I got any fatter.
Yeah, the cold is coming. It ain't going to help, right? I'm sure.
Somehow, Tim, I think you take pretty good care of yourself.
He does.
But,
he does.
Here we are, I
wore the Italian shirt just for you guys.
You are always dressed to impress.
What's that, a Bugatti or something?
I can't remember. It's from Bellagio which is on Lake Como. And I'm not cool enough to wear this shirt, so don't let it get out.
I like the color.
You're pretty
like
cool,
the,
Tim.
I like the blue.
No
I'm going with
self-respecting,
cool.
no self-respecting Italian would wear a T-shirt with it. You know, it's as the guy who sold it to me said, "Oh no, 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 we wear it next to the body."
Oh,
But I'm wearing a T-shirt. It's
You got to take it down a couple buttons, man, and then show us
Miami
that.
style.
All right. Key data
I'll tell you,
points.
the Italians are cool.
Key data points on broad performance for year to year, year to date investors. I mean, I don't want to start, tax selling. I mean, that's what this is leading into. I mean, there's a lot of tax selling going to be going on. So why don't you give us your perspective?
Well, and this all comes around to how to be successful as a trader. But here are your two Italian words for the day, and they will dovetail with what you were saying, Dennis, as I was waiting backstage. But these are your words for the day: certo and chiaro. These are two of my favorite Italian words, and they mean certainly and clear. And what is certainly clear to me is that I'm not going where you think, that the Nobel Committee for Economics is a confederacy of dunces, because they awarded Ben Bernanke the Nobel Prize for Economics today. If you have missed that.
Tim stepping up to the plate. At least someone out there is willing.
I mean, nothing confirms the presence of idiocy more to me than that. And it, dovetails with what you said, Dennis. We're, if you look at where the market is, we are 5% above where we were. Where SPY or the S&P 500 was, SPX if you prefer, they closely track each other, on February 14th, 2020. I like to make 5% a week trading. Doesn't always work out, but this is after the most colossal Bernanke helicopter Ben experiment in human history. It's been pervasive, and I realized that he wasn't given the Nobel Prize for what he did in 2008 or his contributions to efforts to address the pandemic, but it's going to get, as they've said on CNBC Squawk Box, it's going to get contextualized. The public is going to look at this and say, so let me get this straight, that the government lauds and praises the central bankers who have just demolished purchasing power. It's pretty good in Europe for us who use the dollar. But if you go to the grocery store, it's a mess. And then to your point, Joel, you were asking me about these data points. Well, and I can't take credit for these. Goldman Sachs came out with a whole litany of data points this morning that I thought were pretty interesting. Here they are. So the average stock picking portfolio year to date is down 24.8%. The S&P 500 is down 25%. There is your clanging klaxon indicating that there's a whole lot of closet indexing going on, but this is what these policies hath wrought. So not only does our money not go as far as it used to, but the market has been demolished. A 60-40 equity bond portfolio is down on average 21% this year, second worst on record going back to 1900. The only worst year was 1974. When I was growing up on a cattle ranch and we had sold the ranch, or we had leased the ranch with an option for the buyer to buy it or the lessor to buy it, and they backed out because the economy collapsed in 1974. This is the comparative. We could go on with these data points, what the expectation is for earnings. And I look at this and think, so you award the folks who created this policy that we just use money as the great panacea instead of value, and I don't understand it. So other than that, everything's fine. We can talk about what you do in these circumstances. I've done fine trading with supply and demand, not price. I think that those will always help you.
Can we jump into the supply and demand and let's just go and look at the overall market, or we can look at some of the big guns here too? Maybe we should go to Apple, because we've got Apple earnings in a couple of weeks here. There is a lot of differing opinions here. Some people saying you got to own, like Kramer, you got to own Apple. It's pulling back here. It's significantly off the highs. And then other people, on the other argument, which I'm on the other side, saying that, hey, it's 24, 25 times earnings and there's no free money anymore. And could be a different case. What does the market structure show on Apple?
To me, I wrote about this to edge users in the market desk note today, that what if there has been one resounding lesson to me. I realize I'm biased. I think in terms of market structure for 2022 about the market, it's that price is a lousy indicator of what and when you should buy. And to your point, we could say, well, 24 times too expensive. How about 15 times? Is 15 times a fair multiple to put on a stock? Or this stock is down 10% from where it was. I think that's an attractive entry point. I'm not saying that either of those views are incorrect, but what are they based on? They're based on comparative prices. That's it. And it's got nothing to do with supply and demand. And the stock market is driven by supply and demand, just like any market is. And we've learned that dumping money on an economy causes people not to work, which disrupts supply chains and drives up the prices of things. Then we have too little supply, then we react to that, and we have too much supply. And the stock market is the same way. If you were going to buy Apple, you would want to buy rising demand and falling supply. And should you own Apple? Even Kramer, I saw his latest ad. He's saying not buy and hold, but buy and homework. Do your homework. So he's moved away from this idea of, I did a long time ago. I don't like the fact that the market is short term, but it is. The rules advantage short term participants. The evidence abounds. All you have to do is look at who's rich in the equity market, like Ken Griffin and Jim Simons, folks who have been very successful trading short term. So if we look at Apple, here's price. This is a 30-day view. So from August 26th to October 7th through Friday, that's price. The green part is demand. 5 is the minimum. 5 is the fulcrum for the teeter-totter. And it's not been above 5 at any point during that period of time. And here's the supply side. Supply is short volume, the amount of artificial liquidity in the marketplace. Well, supply is above trend and demand is at 1. Am I going to buy that? No, I'm not going to buy it. It has nothing to do with whether Apple is a great company or not. It has to do with whether you can produce returns. We trade things to produce returns, either long or short, or you could say the gap between if you like to trade volatility. I use both. I use supply and demand and volatility. I like to buy and sell things that have 4% volatility because I can make 2 on it. And if you do that over and over, you can be very successful. To me, Apple is not the place to be right now. So
it's tough to be bullish equities if you're bearish Apple. And this is just because, US, obviously the indexes are so heavily skewed to these 5 to 6 mega cap companies here.
No question.
And this is probably, this earnings season, once we get into the thick of it, and you get the Apples and the Microsofts and the Googles and the Amazons, this is going to be what's going to drive the next move. So, let's just go to the next one. Let's just go Microsoft, because Microsoft has been beat up here too. And are you seeing a similar story in Microsoft? The stock just is it's trying to make a new 52-week low here. Yep. So, which is not good news from, a technical perspective, but sometimes market structure tells a different story. Right. What do you see with Microsoft?
And I completely agree, Dennis, and it's one of the mantras that I repeat over and over, like a form of theology, having just visited Vatican City, that the market cannot sustainably rise without tech. And it's because tech is such a large part of the market. Communication services, the tech stocks that are in consumer discretionary, like Tesla. Then you have the FANGs, or whatever we call them. We haven't sorted out what name to put on these stocks now. But over here, we'll go look at Microsoft. But here's the group. So I've got 11 stocks in this portfolio. So It's tech dominated. Passive investment is the key behavior. It's been a seller. Well, how would I know? Because the demand side of the chart, putting those 11 together, is never gotten above 5. Now it's rising. It's rising at the moment, but so is the supply side. If demand and supply rise at the same time, the likelihood that the prices rise is diminished. The price just stall out. It tells me passive money, the big portfolios are getting outflows, redemptions. They will be forced to sell things. If I'm an investor in a fund and I sell the stock of the fund, then the fund is going to have to sell the underlying assets. This is a basic mathematical fact. And I explain this to public companies all the time. Oh, our stock is down 30%, so we're going to target a bunch of investors. Well, good luck with that. If they have redemptions and outflows, they're not buyers, people. That's confusing busy with productive. But you have to think about those things, traders. What is the big money doing if it's heavily exposed to tech? Well, it's got redemptions and tech is going to struggle. And if I look at Microsoft, so here you look by ticker, and the mouse over that and we'll give you the name. It's at 6 and trending up, and supply side is down. It's better than Apple, but still, let's look at the supply demand equation. That's the key to me. Here's demand. Demand's ticked up above 5. It's the first indication that there's excess supply or excess demand in that stock. But supply is up too. So that's long short strategies. The likelihood that Microsoft posts sustainable gains is very, very small. What you need to have gains is this. See how demand rose above 5 and supply was below trend? That'll give you a little gain. But the moment that supply rises and demand stalls or begins to fall, leave. Take your gains and don't come back until those conditions return, because otherwise you're just wasting money. You want to produce gains, not losses. At least I do. That's the aim for me. So again, Dennis, I'd say, well, it's better than Apple. It's not where I would have money.
Where would you have money? On the long side, where would you have money?
Going into earnings season too. Yeah.
Right, earnings, we always tell folks, beware of options expirations and beware of earnings, because they can warp outcomes because there are bets tied to derivatives. So notice that this is today's list. I've only got 2 companies in here at the moment. There are others I like. I'm happy to show you where those are, but look at this. Demand is screaming way above 5 and supply is falling. Those are the conditions that produce returns. And it doesn't matter what the broad market does. It's right. I traded when the market was down 500 points and my positions were up. That's what you want. Maybe not a lot, but it doesn't take much. So I look here at Marathon Petroleum. Denbury Resources is a harder trade because it's not very liquid. Trades 489,000 shares daily on average, $4,600 a trade, 3.4% intraday volatile. I just want a piece of that. So if the stock's down 2.5 or 3%, I buy that because there's a supply-demand imbalance that I know is likely to benefit me within a day or so. And notice that fast trading machines are the lead behavior. If you look at the supply-demand balance in Denbury, you'll either of these is a good example. Here, I'm going to do it up here. I think it'll be easier to see.
It's like energy.
Energy is still attractive, no matter what you see. I would say energy, financials, healthcare. Those are the sectors that show diverging supply and demand. And I will look for this. This is what I look for. And these are the things I trade. If something hits 10 and supply is falling, the probability of producing a return, no matter what the broad market does, within a couple of days is very high. The thing that everybody gets wrong is that they hang around too long. You gotta, if your position's up 2 or 3%, take the gain and let's go find another thing like that to trade. And if you repeat that over and over, you will be up while everybody else is down, because you're not fixated on price, you're fixated on supply and demand. And those are timeless principles.
I think you just made the point of 2022, and it's traders. You've been making this point off and on for the last, 17 minutes here, and it's correct. Yeah. The traders who are making money, the Ken Griffins, the short-term traders, the day traders are doing well in this environment. And, the swing traders are struggling a little bit more because they're sticking maybe around for a little bit too long. Right. You get that gain. I've been saying it too. In 2022, you take the gains or the market takes them for you. If you stick around too long, those gains just evaporate away, especially on the long side, maybe not on the short side, but, predominantly 90% of traders, listening to the show a lot are mainly long traders. So, we've got to talk from that perspective. Because, even in Robinhood, they don't even allow you to short stocks. So, you can buy some SQQ or something to try to get some exposure there. But for the most part, it's a long-only market. But I think you've got to take the gains. I think it's a short-term trading environment. You get those gains. I just had Oxy. I took some heat on it. It just had a ridiculous move. I mean, from 57 to 72 in like 8 trading sessions. It's like, oh, you don't get moves like this very often on the long side, even in oil stocks. I'm like, I've got to, I don't want to stick around too long and just watch it pull the rug out from under me.
And there you go. The reason for those big gains is supply plunged way below the trend down here. That's a big. If there's any increase in demand, there is going to be insufficient stock to satisfy it, and it will cause the price to rise very rapidly. And you saw that. The demand soared. Now supply is way above trend. Demand's still rising, but I would look at this and say, now is the time to take your gains and go find another opportunity where these are diverging instead of starting to converge. But you're exactly right. I mean, it will. That's why there's a supply-demand divergence. If you look at the broad market, here's the problem. Why does the market struggle so much to hold its gains? We've had some nice moves in the market here. This move that we had to begin October, new month, new money. But I could look at it and go, well, there's a supply deficit, and that's likely to produce a run. But we didn't have a lot of opportunities. I use machines for this. Give me big and stable stocks. Give me volatile tens, I call them. Give me momentum trades, and it was giving us nothing. And that was very telling. I told everybody, look, if you have a move, take the gains, because these data are telling us it's very unstable. And here's the problem. So even though this is a big deficit, it's nowhere close to the one that we had back here. And if you go back to June, it's not even close to that one. So our lows in supply are much higher. They're steadily higher, and that will undermine the broad market. And it all goes back to tech. If tech is not rising, there's going to be more money, long, short, global macro money that is short tech, and it's going to show up. And who's winning this year? The average stock picking fund is down 25%. The average global macro fund is up 32%, because this is what they're doing. They're using these supply-demand imbalances to benefit their positions, and they're doing it by being short tech. So we have to beware of those things.
Well, thank you for joining us today, Tim Quast. Like always, you guys can check out Market Structure Edge for yourself. If you guys want to have access to this data, check it on out. Appreciate it, Tim. Have
Good
a great
to see
one.
you guys.
Take care.
Arrivederci.
All right, let's keep it going, guys. Let's take a look at the overall market. Last levels here from Joel Elconin. What are you looking at, Joel?
We're just floating higher. We got past unchanged on this session, and boom, they're just lifting offers here. There's nothing in here. Topsky mentioned a level, and I'm going to go with that too, because I have a weekly number and a daily number. They usually don't come don't always hit together, but with the crazy range that we had last week, and then that big range that we had on Friday, I'd like to see what happens at like 36.80. I mean, I know that's only 16 handles away, but if we're gonna
Show that SPY chart.
Oh, I'm sorry. For
Still
the
an Oxy.
SPY, I got
Or you can show the
Oxy up
futures if you
there.
want.
Yeah, it's not too much. It's not too much higher than this. I mean, there's nothing in there. Maybe that would equate to 370 in the spider. The S&Ps, it comes out to 36.80. So another 15 handles. So what's that? Another 1.5 points, but that's what I'm looking at for the week. But not. I mean, we're coming off the lows, and not much up there is resistance. If we start to come back down, always looking at that closing price of 53.25. But right now, they just seem to be lifting up. Did you get any buying balances or anything stick out to
No,
you,
it doesn't
Dennis?
even
No?
look like much buying balances. They're
So-
small. What I am seeing, and what you're seeing is just a bounce off the lows. And you've got this support down there at 360. We know that, so I'm not surprised. Overnight we get down there, we retest the lows again. Really on the S&P, like 350. Like if you go to the futures chart, you can probably see clear because SPY maybe wasn't trading, on some of those prices. But we're retesting those lows and they're holding.
Right here.
I think you got to consider just so many people caught maybe a little bit on that number on Friday. It was really ugly. I think you have a whole new group of bag holders. So I start thinking about like the 50% retracement just from Friday. I like that. 373 down to 362. Get up to 366, 367. I'm selling stocks. So I think we get up another 20, 30 handles from here. I'm selling the rip. And especially if I'm overweight stocks, I'm selling the rip rally right now if I was overweight stocks, but I'm not. But I'd like to get up a little bit higher just to sell stocks and maybe initiate some shorts.
We'll see what happens. I'm watching the dollar start ticking down there. That
Yeah,
could have
that's
been
helping.
a
Yep.
little help there. So I'll keep watch on that. And also talked about crude was pulling back, right? Keep your eyes on that. That inverse relationship, right? Now it's starting to get a little bit of a spike, looks like towards 850. So I'll keep watch of energy also. Seems like that relationship has come back last week where oil up, market down. We'll see if that can continue this week. Anything else you guys got?
You're
No.
really seeing tech kind of has turned here. When we started the show this morning, tech was getting beat up pretty good. Actually, you're starting to see it turn around here now. If I'm just looking, though, it's kind of like, again, I'm going to go back to when the VIX is above 30, everything kind of moves together. You're kind of seeing this market still, everything's moving together. Utilities are starting to catch a bit, healthcare stocks. You're just seeing everything just kind of move together to a certain extent. But that inverse relationship with oil is definitely there too. But, here you are, oil's, up a little bit here again today, but equity markets are starting to go too. So it's just everything's moving together, but I just don't see us out of the woods here by any means. I can't be.
Everything's
heavily long
everything's fine and dandy until like someone comes out like AMD.
That's what happened.
That's
and the problem, Joel, is there's going to be so many more AMDs. What happens if that's Apple? What happens if that's Microsoft? What happens if that's Google?
It was bad enough with AMD because if you think about it, that fundamental news came out Thursday after the close, right?
Yeah.
And on the show on Friday, we're like, why are we unchanged? Why are we unchanged? Why are we unchanged? We're like, oh, we're going to get higher unemployment. That's why, people know the number. And then the unemployment ticked down and the fundamentals, came back into play. Just before I let you go, for you oil traders here, working on a red bar for the first time in over a week. I'd keep it if you're looking for more follow through for Mitch's $180 target. You got to get through 93.50. That's a pair of highs from the last two sessions. So everyone have a great day. Back with you later on.
See you, Joel. And of course, you guys can keep up with Joel at PreMarket Prep Plus. And Dennis, have a great one. We'll see what happens today.
Mitch. Good luck,
and keep
everyone.
battling. We'll see what happens, like always. All right, team, let's keep battling. We're going to get you over now to live trading, and Zunaid should be back. So I'm ready to go ahead and hop back into the driver's seat, see what we can find, see what trades are working. Of course, energy was really hot last week. Will it continue? That, of course, being pointed by Market Structure Edge, seems like energy seems to be the play. What I will be looking at is maybe not some of the leading names, maybe some of the laggard style, like you saw mentioned there, MPC. We'll keep an eye out on some of these. Come on over to live trading action. If you guys want to go ahead and see Lord Ryan, myself, and Zunaid do some trading today, let's get into it. I'll see you guys right over.